Hello, everyone. Happy Tuesday. Welcome back from the long weekend. It's Tuesday, February 21st. Today on the Final Bar, we'll be talking with Danielle Shay of Simpler Trading. We'll talk about some of the charts on the move in her world, particularly one consumer discretionary name we certainly want to focus on dropping due to earnings. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of technical analysis. The technical toolkit is designed to help you understand the markets by focusing on investor behavior, right? And price as an accurate reflection, ideally, of all the buy and sell decisions, all the emotional state of all of those individual investors and institutions and elsewhere, all kind of coming together to settle in on a price. By analyzing those prices over time, we can make a better sense of where things have come from and start to anticipate where they're headed. We're also going to focus on price breadth and sentiment and other indicators through the course of the day today as we digest this sort of distribution phase that, if it hadn't started before today, certainly feels like it's happening today. Major averages down pretty significantly as we're prepping for the show. The market's kind of rolling over. The NASDAQ down 2.5%. So we'll look at what this means for one day, but also what it means for the bigger picture. Where are we at relative to key levels of support? What does the move, last week into this week so far tell us about the overall market conditions? What can we learn from looking at individual names like Home Depot in the news and earnings miss, the price dropping? What does that tell us about the overall sentiment and what may come next? We'll try to answer all those questions the best we can. Wanted to move on to our market recap, starting with a poll. We always have a poll running on our live stream page at StockCharts.com, also on our social media accounts. So give us a follow on Twitter and on YouTube as well. We asked you, in a downtrend, a long down candle is followed by a long up candle that closes about 75% of the way back up the first candle's real body. Which pattern is this? 58% of you, 100% right. That's called a bullish piercing line. Now, I've often told people when you're learning candle patterns, I am super not crazy interested in the names of the patterns, although they're interesting. The real meaning is when you think about what the patterns represent, right? A 2-day pattern where you have a big down day, then a big up day, and enough progress is made that we get over half of the way up through that first day's body. Think of that as a short-term reversal signal, a positive development, short-term positive sentiment. It's called a bullish piercing line, and that's what it really reflects. If it would go above the previous day's open, so it would engulf the previous day's body, then it would be a bullish engulfing pattern. So that's the difference there. By the way, if you don't know these patterns and if everything I just said does not make sense to you, go to our Chart School page on our Stock Charts platform. Chart School is a free resource. Look at the articles on candlestick analysis, and you'll learn all about dojis and engulfing patterns and bullish piercing lines and how they can help you understand the short-term dynamics of the charts you're looking at. Continuing on with our market recap here, number of things I wanted to talk about. This is one of those days where we've got plenty of things we can cover because there's so much movement today. Friday, we talked about this sort of resilient move into the long holiday weekend. The S&P closing just below 4080. Felt like a pretty constructive setup leading into this week. Today, we're given all of those gains back and much, much more. The S&P could not find its footing on the way down. Not too long ago, I feel like a couple days ago, we're talking about 4,100 and whether the S&P can hold that level. We broke below there last week, and all of a sudden it was, all right, is 4,100 going to be the new level to overcome? Now, all of a sudden, 4,000 back in play, and that 4,000 handle, and a key one and today we actually went back below it. The S&P closed down about 2% today. That's just around 39.97. Underperforming to the downside, pretty much everything else. The NASDAQ composite was down 2.5%. Small cap index, the S&P 600 down almost 3% today. Now, this negative move, this distribution phase today, pushing volatility back up to the upside. You have the VIX up to around 23. Now, last week, we're talking about whether the VIX can get above 20, because we'd had sort of this rally phase going into the beginning of February on relatively lower volatility. The VIX had remained at or below 20 down to like 19 or even 18. Now all of a sudden way back above there and pushing higher. So the bear case from here, I would argue, besides having a lot of red and the price going down, would also include volatility increasing, which we're certainly seeing today, and things like high yield spreads widening out, which you actually saw leading into today as well. We'll look at each of those charts if we have time here, but I did want to highlight some of the other asset classes. Interest rates coming higher as bond prices sold off along with equities through the course of the day. The 10-year yield around 396, long bond yields around 398. The dollar index up about 0.33%. Commodities a bit mixed, with gold down about 1/3, silver up 1/3, and the general commodity ETF that we track, the DBC, was up just above zero. Not too much of a big move to the upside. Energy ETFs, for the most part, down in the red. All red, looking at the top 10 cryptocurrencies that we track on our platform, both Bitcoin and Ethereum down between 1% and 2%. So not a horrible big down day, but certainly feeling the risk-off feel or the risk-off sentiment that we saw with equities and with bonds. You're seeing that in cryptocurrencies as well. So risk assets in general kind of rotating to the downside today. Let's look at a daily chart of the S&P 500 just to see where we're at. Now, one of the trend lines I've been drawing, I feel like there's a signal that I'm creating all by myself, which is the thickness of the trend lines. Because anytime we get really close to a trend line, I start making it thicker because I want to make it more and more clear. So jot it down. The thickness of Dave's trend lines could be a good leading indicator of importance of key breakouts and breakdowns. We highlighted the trend line connecting the highs through the course of 2022. If you take the January high, the March high, the August high, they lined up almost perfectly and connected well with the November, December peaks that we saw there. Also lined up with the first real peak in mid-January before the breakout in the second half of last month. From there, of course, the S&P reaching almost to 4,200 and now retracing back down into this blue shaded area, which is the area of support we've talked about. Now, what's interesting about that 4,000 level, besides being a big round number, actually has a couple different things that are all lining up right around that 4,000 point. This Fibonacci level right here is if you take the August peak in the S&P and take the October low in the S&P, 61.8% of the way back up is just above 4,000. That's that level right there. That also happens to be a 38.2% retracement of the 2022 sell-off. So take the January 22 high, the October 22 low, 38.2% of the way up is right around 4,000 as well. So we have a number of different Fibonacci frameworks, all sort of identifying that 4,000 level. That's why it's the lower end of this blue shaded area. The upper end was 4,100, which is the swing high there in November, December. So we talked about, can the market find a footing within this area? And up until today, it seemed very straightforward that it was doing so. Today, actually, we closed below 4,000 for the first time since mid-January. Now we're testing this trend line from the lows in October, the low in December. And I should point out, by the way, that January, that is, I should point out, by the way, that this is one of those weird times. Sometimes if you use intraday highs and lows, which I'm doing here, or if you use closes, because the close is actually up here and here. So the angle is actually a little different. So if you use the intraday lows, which I'm doing here, we're actually very, very close to that trend line. And it lines up with the 50-day moving average, which is currently around 39.80. If you would use the closing prices, the trend line's a little gentler slope, and it lines up more with the 200-day, which is here around 39.40. Now, we talked about the 4,000 level, talked about the 200-day as a really important level to watch. The question mark for me is, do we find a footing there? The RSI, by the way, is getting near to 40. That's where it bottomed out in December when we had the pullback there, and then the return to a new swing high because the momentum remained fairly constructive. So as we sell off here today and potentially through the rest of the week, as we digest this breakdown, the question is, do we hold this sort of confluence of support? Just like that confluence of resistance that we talked about in January, we're now sort of seeing the opposite as the S&P and the NASDAQ attempt to find some sort of floor. Another thing I want to show, maybe two more charts, and then we've got to wrap it up. I was looking through in my morning coffee routine this morning, going through a series of charts. One of the things I was looking at is Dow Theory. We talked about how the new Dow Theory, which is this chart here, the new Dow Theory is, I think, a modernized version of what Charles Dow was really trying to do, which was looking at two main pillars of the economy to see whether or not they were agreeing that conditions were positive or agreeing that conditions were negative, or if there's some sort of disagreement, what we'd call a non-confirmation. The S&P 500 and the NASDAQ composite, I think, are a great reflection of sort of the old economy versus the new economy. Are they in agreement? And as of late January, early February, I would argue they have been in agreement, both making a new swing high, right? Both getting above their high from the end of November. For now, they've pulled back a little bit, but not making a new low and not really close to that. But look at what happened to Charles Dow's really original methodology. Now, it's not exactly what he had because the Dow Industrials look very different than they did when he was sort of pioneering this concept, and the Dow railroads were used because literally that's how goods would get shipped around the country. When we're looking at the Dow Industrials and the Dow Transports, though, it's really interesting as I'm going through these charts that in late January, early February, the Dow Transports broke out along with the S&P and the NASDAQ. They all got above their high from November. But look at how the Dow Industrials actually never did. Now, what's interesting is if you look at the 30 stocks in the Dow, it's kind of a mix of course, mega cap, sort of blue chippy kind of names. You've got some energy in there. You have financials, you have consumer, you have technology, you have a bunch of different things all mixed together. But it certainly includes some of those areas of the market that have not been as strong here in early 2023. So you actually have a Dow Theory non-confirmation in February. So if we would sell off from here, it turns out that traditional Dow Theory, the Dow Industrials and the Dow Transports, a signal that the February high should not be trusted or should not have been trusted. Something to maybe watch to see if we get some sort of renewed strength in certain areas of the market. Just to finish off talking about some of the sector movements, and then we'll highlight a name or two. Consumer staples, number one here, down about 1/3%, followed by energy. So all 11 S&P sectors down, but those two were down the least. The worst performing sectors, some of the FANG sectors, consumer discretionary down 3.33%, technology down about 2.33%. My friend Tom Boley, who does a fantastic job with his show Trading Places with Tom Boley and over at Earnings Beats, he was writing some commentary and articles about seasonality. And one of the things that I wanted to highlight that I'm drawing from some of the stuff that Tom was writing was just the seasonal tendencies. While April actually tends to be pretty strong for some of the offense versus defense comparisons we would make. And one of the classic ones is looking at consumer discretionary versus consumer staples. If you look in April, that ratio is actually up 68% of the time going back for the last 20 years. But look at the weakest month out of the 12. It's actually March. We're heading into a fairly weak period for seasonality. It gets even more exciting if we do the XLU versus the SPY. That's not it. SPY. Here we go. If you look, this ratio has been up 74% of the time in March, meaning utilities, a fairly defensive area of the market that investors, particularly institutions, only use if you want to sort of get defensive and sort of ride out a period of market uncertainty. February actually tends to be pretty weak for utilities, but March tends to be pretty strong. So you have some signs indicating seasonally that March can be weak, even though the first half of the year in a pre-election year actually tends to be stronger than normal. Let's take a quick commercial break. We'll be back with Danielle Shay of Simpler Trading. We'll see you in a minute. Hey, everyone. Welcome back to The Final Bar. This is Dave Keller here at StockCharts.com. It is a pleasure to have you join us every weekday after the close. We have our brand new StockCharts TV studio, so close. We're doing some final testing. We hope to be back in there soon, and excited to have some new improvements to the show through the course of this year. A couple quick announcements before we bring on today's guest, Danielle Shay. First off, we welcome your questions. We had a great mailbag segment on Friday of last week. We'll do another one at the end of this week, and we'd love to feature one of your questions live on the air. Our email is thefinalbar@stockcharts.com. We are on Twitter @FinalBarSCTV, and we're on YouTube. Put a comment below the video you're watching on our Stock Charts YouTube channel. We'd love to hear from you. We hope to answer your question live on the air on Friday's show. Upcoming schedule, I'm really excited to talk to Danielle Shay. It's been a little while since we've had her on the show, so excited to see what she is seeing and hearing. Tomorrow on Wednesday, the 22nd, we have Dave Landry of DaveLandry.com. On Thursday, February 23rd, wealth manager Louis Llanes of WealthNet Investments down in Colorado. Next Tuesday, we have Chris Verone. Chris is the head of technical research at Strategas Research Partners in New York, research analyst that I followed for years on the institutional side, and excited to welcome him to the Final Bar. I want to bring on today's guest, Danielle Shay. Danielle's the director of options at Simpler Trading, coming to us from Austin, Texas. Danielle, great to see you. Welcome to the show.
Thank you. Thanks for having me.
I appreciate you being courageous enough to come on a day when I feel like as we're prepping, the markets just continue to push to the downside. But I think our viewers need your insights now more than ever. I would say we're starting with the chart of the Qs. Obviously, some of the Nasdaq heavier or tech sort of areas of the market struggling today, sort of leading the way lower. When you're looking at the chart of the QQQ, what are you seeing? What does it tell us about the overall conditions here?
So when you're looking at the Qs, I mean, historically, what I usually trade in January and, into the first part of February is this January effect, the rally going into technology earnings. And then after that, just from a seasonal standpoint, I look for the market to trade lower because, we have this exuberance and this excitement going into Microsoft, Amazon, Tesla, Netflix earnings. And then after the fact, it pulls back. So what we saw in the Qs is we saw that rally, right? And it traded higher directly into earnings. And at this point now it's pulling back. So I'm in this point where I am actually trading it to the downside. So when you're looking at the chart, you can see that there's a 50 simple moving average. That's going to be my next target. Really, we have 290s. 290 is a key psychological value and it's a decent target, but I think that 285 is going to be the next best target. So I'm trading this to the downside. I am looking to see which one of these support zones is going to hold. If it hits the support zone and it breaks, obviously you look for the next support zone. But if it hits and it holds, then hey, maybe we can trade it back higher. But I do think that we're going to see more weakness ahead.
When you're thinking about, I want to go to your second chart, looking at the XLY, Danielle. Consumer discretionary has been one of those charts that really reverted. And when you think about the sort of renewed strength of the markets coming off the October lows, the XLY really sort of came into its own in the new year. What are you seeing now? Is anything different, or is it still feeling strength off of the lows here?
So the strength off of the lows was great. And when I was looking at what has occurred over the course of the past 2 months, looking at the charts, if we could have continued this rally, that could have been the moment where we broke out of the bear market. But the problem is that we're still in a downwards channel. And when we're looking at the weekly charts, you can see a bearish head and shoulders pattern. And when you look at the rally that occurred over the course of the last, month and a half, 2 months, all that did was create that right shoulder. And when you look at the right shoulder, you can see multiple bearish signs. You can see the wicks at the top of the candles. You can see the way that it rallied directly into resistance. You can see that the way that the candles are stair-stepping lower again. And so while the rally was great, all it did was create a very bearish long-term pattern. And so if we're not able to break through that right shoulder, which as of now, we have not been able to at all, then the path of least resistance is lower. And that would just bring us back down to the October lows.
When you're looking at it, just, and I should have made a point, thanks for mentioning the weekly chart. First one was a daily chart of the Qs. Here we're looking at a weekly chart of the XLY. What would you see on this chart? You mentioned sort of the right shoulder forming, the long, wicks on the candles, which is a brilliant point to recognize. What would you see on this chart that would turn you more constructive? What would tell you that actually things are starting to improve? Is there a particular level, a signal? I know we have the TTM squeeze at the bottom. Talk us through what you would look for that would start to look more constructive in your eyes.
Yes, definitely. So I use the squeeze. I absolutely love the squeeze. I'm a directional trader. And what I'm looking for as it relates to the squeeze is a consolidation breakout. So the squeeze is a consolidation breakout tool. The squeeze, the majority of the time, it's going to fire in the direction of the trend. So when you're looking at XLY right now, you have that consolidation and you have that head and shoulders pattern and you have that squeeze, right? And so we know that it's going to break out one direction or another, but because it's in that longer term downward channel on the weekly chart, and because it's stuck underneath, I would say if you're looking at levels, definitely 160, it would absolutely have to breach up above 160 for me to say, hey, you know what? This isn't a bearish chart. We're reversing. I'm wrong. But as long as we stay below 160, and especially as long as we stay below the August highs around 175, then the path of least resistance is down. And when you have a squeeze like that, and when you're running into the 50 simple and the 200 simple, That is a major ceiling right there. And when you have price hit that level and it can't get through it, it's highly likely for that squeeze to then fire to the downside.
Home Depot, of course, one of the big names on the move, and earnings missed before the open, really setting the stage for a negative day. This is a weekly chart of Home Depot. Talk us through what you're seeing here and what we might want to expect next here.
So when you're looking at Home Depot, you have that same sort of pattern as well. It's a little bit sloppier, the sloppier head and shoulders there. We've traded up into that right shoulder. And then what you have is you have this major catalyst, which is earnings, which could have been the catalyst to break out of that downward channel and break out of that bearish head and shoulders pattern, but it wasn't. It was the catalyst to send you right along with the trend and trade lower. When you're looking at XLY and you're looking at the top three components, you have Tesla, you have Amazon, you have Home Depot. Home Depot is going to have a major impact on the sector overall. And we're seeing that today with how much it's down. And so when you have Home Depot coming out and saying, hey, guess what? Inflation is really impacting the way that the consumer is spending. The consumer is not as interested in spending money on goods right now. Consumers are shifting to services. We've seen lumber prices come down. That's impacting our bottom line. And we're just projecting for our sales to be flat this year. We're not projecting overall growth. When you have large corporations, particularly, one of the top 5 weighted stocks within the overall sector, coming out and weighing down the market, it's pretty much impossible for that overall sector to continue higher. Now, yes, it does have Tesla involved, but Tesla and Amazon are both, clinging to a thread as well. Tesla's clinging to the $200 price point after the massive rally that it had. Amazon is clinging to support. So I think that with these 3 stocks, definitely need to watch them very closely. And it looks like, oh yeah, so Tesla just broke $200 right at the end of the day there. So Tesla breaking $200 a share, not good for Tesla. And, again, that could very quickly fall as we saw it rise so quickly throughout the course of the last, 45 days.
When you're, if we could, we have a couple more minutes left. I love Danielle. Home Depot is one of those names that it sort of had a certain feel. And then today, all of a sudden, everything seems to change very quickly. Can you talk about, in your experience, how do you approach something like an earnings release? Do you tend to sort of just get away and sit on your hands metaphorically and just wait to see what plays out? Or do you have a sense of directionally what you would expect? Like, how do you think about trading around an options report? Or, an earnings report?
Oh, definitely. So I'm very active as it relates to trading earnings reports because I'm an options trader. It provides pretty good opportunity just because in the options market, you have the increase in implied volatility going up into the report. And then after the report, the implied volatility gets crushed. And so you have options that go up in value and then they go down in value. So it creates this opportunity where you can sell options a lot of the time. Now, what I usually look at as far as trading a report is I want to look for some sort of pattern. I have a tool that I use and it's called the earnings hot zone. What it does is it looks at the chart, and usually I like to look at about 2 to 3 years of data. And what it does is it crunches the data and it shows me how much the stock normally moves on earnings in a dollar and percentage base, whether or not it moves up or down. And then also how it moves prior to earnings and how it moves post earnings. So for example, I will like to look at stocks a few weeks prior to earnings. So some companies that are really bullish in nature, you will see a run up into that earnings report. So I'll trade it that way, 2-3 weeks prior to a report. And then some stocks just have an obvious pattern over the report, whether or not they typically fall. Like, for example, NVIDIA. NVIDIA is a strong bullish company. We've had a massive move in NVIDIA over the course of this year. But if you look at the earnings stats on NVIDIA, you will see that even though they normally do well on earnings, the stock will oftentimes drop post report. So
Hmm.
I use statistics like that, and then that's how I will trade them in the options market. And definitely there is sitting on hands too. There's times where I don't want to touch that.
Well, I love your point, Danielle, which is basically looking at the data and really trying to understand how these companies, relate to their earnings releases. If there's any patterns you can look for there, Danielle, I wish we could talk for so much longer. It's been a pleasure to have you on. Welcome back to the show. Welcome back to Simpler Trading. We'll look forward to talking to you again through the course of this year. All right.
Thank you. It's been great. I hope you have a great rest of your day.
That's Danielle Shay. Danielle's the director of options at Simpler Trading, coming to us from Austin, Texas. I love that some of those comments thinking about earnings at the end there, and what I love about it is just really thinking about the data. How do these companies tend to perform leading into earnings? How do they perform leading out of earnings? Thinking of earnings as a catalyst, and while you may not be able to predict exactly what the earnings call may contain, you can certainly look at the tendencies. And I would 100% agree. I know in previous lives of mine at Fidelity and at Bloomberg, we had all sorts of data we would crunch about trends leading into a report, coming out of a report, and we certainly found that there was some information there, some opportunities to bet on some of the normal progression going into and coming out of earnings. Great take there, and much appreciated from Danielle Shay at Simpler Trading. We need to wrap the show, folks, and go to the 3 and 3. Let's talk about 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. I did a webcast earlier today talking about breadth indicators, and one we spent a good amount of time on was this chart, which is the percent of stocks above their 200-day moving average and their 50-day moving average. What is really interesting about this chart today, going into the weekend, we were up at about 65% of the S&P 500 members above their 50-day moving average. By today's close, we have now broken back below 50%, just barely. We're at just above 49%. However, that 50% line is an important one. The fact that in December we got right about to these levels and not much further to the downside suggested to me that this was a short-term pullback and not the beginning of a retest back to the October lows. Do we get that same signal this week? I'm concerned that these indicators continue to go down, which would certainly indicate more of a steeper drawdown and a potential retest, certainly of the December low, if not further. But one thing at a time, right? Let's look at some of these patterns and see if they hold that 50% level. By the way, percent above their 200 days, still well above 50%, but that also held the 50% line in December. So this is an important chart, I think, to watch if you're concerned about market breadth, to see if the stocks in the S&P 500 are suggesting short-term pullback and sort of a buy and hold scenario versus something potentially deeper and more negative. Chart number 2, Home Depot. I liked Danielle Shay's take on Home Depot. Some of the patterns to look at, some of the key levels. This is what my chart of Home Depot looks like. I have to use a Fibonacci relationship to show that if you look at the September low and look at the December high, you'll see 38.2% of the way is right around 315. And that's where we spent pretty much mid-December, if not early December, all the way through mid-February. We keep bouncing just around that level before rallying. Today, of course, gapping now much below that, closing almost exactly at the 61.8% Fibonacci level. So between this and the 200-day moving average, I think we're right at that potential floor. Do we hold it? The momentum is actually telling you no. The momentum is telling you more negative with the RSI breaking below 40. Finally, I mentioned the Dow Theory, traditional Dow Theory, really the closest that we have to what Charles Dow was originally envisioning in the early 1900s, late 1800s, looking at the Dow Industrials and the Dow Transports. Now that the markets are selling off, I'm looking back to see what signals, what patterns really indicated that going into February, that the conditions were weaker than they might have looked. We mentioned with breadth, some of the indicators becoming extreme. We highlighted last week things like the McClellan oscillator breaking down, indicating that there was inherent weakness underneath the hood of the market. How about the Dow Theory giving a non-confirmation? And what a bearish non-confirmation means is one of the two indexes breaks out, which the transports did at the end of January. The other one does not confirm it. And that's what we found in February with the Dow Industrials. Folks, that's a wrap for the show. I want to thank you so much for joining us every weekday after the close. Special thank you to Danielle Shay of Simpler Trading, joining us from Texas with some great thoughts about option strategies and potential risk-off scenario. All of our previous interviews can be found for free at StockChartsTV.com. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be well, stay safe. We'll see you tomorrow. guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.